Hey, what is going on, Cube fam? Good to see you guys here on YouTube. It has been about time, long overdue. We're going to be taking it up a notch. We're going to be doing so much with this channel, from going through models, going through financial statements, charts, you name it. But there's one thing I promise to do more here than anywhere, and that's be a little more bold. So we're going to be making some crazy claims, getting a little more opinionated, a lot of the stuff you guys like, maybe even start some beef, who knows. But that is what we're going to be doing here. We're going to be having a lot of fun. And I think, there's no better place to really start than with Cathie Woods' ARKK fund. A lot of you guys are in this ETF, and if you're not, I get asked about it all the time. So let's jump right into it. Is it a buy? Can this thing come back from the dead? Let's see. Let's take a look at it, guys. Okay, so before we get into everything, let's kick this off with performance, right? That's essentially, at the end of the day, what matters most. What you have here in front of you is ARKK versus the S&P 500 since inception for ARKK, which was 2014. So over the last 8 years, the ETF's been doing well, 260% return against the S&P 500's 156% return, so outperforming the S&P 500 by a little over 100%. This is pretty good. Now, before I get into anything, when we're talking about performance, before we go any further, it's very, very important that I mention, when you're comparing returns, take it with a grain of salt. And a lot of YouTubers don't want to mention this. They just think raw numbers matter when they don't. There's always more to the story. And when it comes to investing, everything is relative, whether it's to interest rates or benchmarks or whatever have you. But in this regard especially, it matters against how much risk you're taking, because obviously this innovation fund is much more risky than the S&P 500. So we'll get into it later, exactly how well is this 260% in comparison to the risk she's taking. That's known as the Sharpe ratio, pretty much return per unit of standard deviation. And we're going to find out exactly if this performance is worthwhile, because anytime someone asks you, what was your return? Or let's say you ask them, what was your return last year? And they go, oh man, I crushed it, 875% returns last year. It should always be followed up with a second question, which is, well, what kind of risk did you assume? What kind of risk did you take on? And if they tell you they were YOLOing options, 0 days till expiration, well, now you have to ask yourself, well, maybe that's not the greatest return, because the best investor is the one that's getting the most return with the least amount of risk per unit, okay, on a unit for unit basis. So this is against the S&P 500, which has a blend of your Amazons, yes, and your Microsofts and your Apples, but also has your Home Depots and your JP Morgans and the like. I want to do something here and add the QQQ, which is the NASDAQ 100. Okay? And you could see the ball game changes a little bit here, guys. And by a little bit, a lot of bit. The QQQ, which is pretty much made up a large part of Facebook, Netflix, Apple, Amazon, your FANGs, NVIDIA, things of that sort, which you could argue is an innovation fund of its own in a sense, because these juggernauts are at the forefront of many booming industries. The QQQ, since Cathie's inception of ARKK, is actually doing better. In the NASDAQ 100, you've seen 274% returns since 2014 against Cathie's 260% return and against the SPY's 156% return. So now let's dive in a little more here and see how things are looking. So over the last 5 years, ARKK has now taken the lead versus the QQQ, 211% versus 185%, and still about 100% more than the S&P at 110%. One thing I do want to go back to here is at the it's 10-year works too, but I'm just gonna go all time. Since 2014, before things got really crazy for Cathie, this ETF, the ARKK ETF, peaked at over 700% return since inception, which was a lot more than the QQQ and a lot more than the SPY. And since then, which we will discuss, over the last 13 months, it's been nothing but a cliff dive. Yes, the QQQ has seen some of a pullback too, but nothing near Cathie's pullback. So we're going to dive into what exactly happened, the holdings that she has. Can it ever get back to these levels? But this is why it sparked so much criticism. They believe, many Wall Street pundits believe, that Cathie caught a bubble similar to 2000 tech bubble like, and now that that's popped, she'll never come back. So we're going to analyze exactly what's happened there, because if we look here during the bottom of the pandemic, everything was kind of in line with one another. Pre-pandemic, Cathie was actually rolling along. So it wasn't just, and a lot of people say this, it wasn't just Cathie catching some wind post-pandemic on stay-at-home stocks. I don't think that's fair to say, but because you see right here, before the pandemic even hit, she was outperforming. She was outperforming pretty much since 2017. She kind of took that leg forward and kept the lead up until pretty much, what is this here? The new year. So let's get a little closer here on time frame. So let's go 3 years now, and we can see the QQQ is up nearly 100% versus the SPY at 66%, and now ARKK is trailing at 43% gain. So the last 3 years have not been friendly in comparison, and unfortunately it gets worse as we go closer in time. So year over year, the SPY and QQQ up roughly 15 to 17%, while ARKK is down 45%. That's massive. And then we go year to date. Things have not been good either for the general markets, but even worse so for Cathie. She's down 29% year to date, while the SPY is down 5% and the QQQ is down 10%. So now let's use the next segment here to talk about the holdings and why things have pulled back and how she's set up to pretty much capture any kind of returns for the rest of the decade. So what we have here, guys, is ARKK's holdings. I'm not going to go through all of them, but I'm going to go through a good chunk of the names that make up a large component of this ETF. And I want to spend a little more time on why her fund has taken such a hit over the last 13 months by going through my Shopify discounted cash flow model. That's really going to be the core that explains of this video, that explains why exactly she's seen such a dramatic drawdown. So let me put my 2 cents in on the top companies here, and we'll go from there. Tesla off the bat, guys. Tesla is probably the main reason everyone knows who Cathie is. She was pretty much calling for this to be a $1 trillion company when everyone was kind of bearish on the company. There was a lot of analysts with sell targets. Every hedge fund was trying to be the one that called the top by shorting it. And she made a name for herself with this stock. And it's one I've never owned, but I've always rooted for. And I would say now more than ever, Tesla actually has fundamentals behind it. They've gotten operating margins into the green. They're now cash flow positive. Deliveries have been ramping up so heavily, even during all of the inflation pressures, all of the commodity pressures, all of the supply chain pressures. Elon and the whole team have really done a fantastic job navigating through the tough environment, and it becomes the leader in EV to this day. And while you have seen like Ford and GM start to really catch a bid, as I mentioned in a video I did at the beginning of 2021, Tesla still is in its own league, all right? And I actually still think it's a decent buy here because they're not just scaling better and margins are improving dramatically. Because a lot of times you used to get a lot of hate for like EV credits, like regulatory credits to boost margins and stuff like that. But that's not been the case nearly as much, if at all, in the last couple of quarters. But it's the autonomy aspect here. If Elon can successfully roll out the autonomous platform and get high margin recurring software revenues from a large portion, doesn't have to be a majority, just a large portion of their consumers, that's going to take Tesla to the next level. So there are still growth levers here. I know a lot of people will get into that debate. Is it a car company? Is it a tech company? Right now, yes, it's still more of a car company, yes, and with a blend of energy there. But if they successfully roll out this this software for autonomous driving, then yeah, you could pretty much say as revenues begin to grow in that field, it will get more of that debate will go away and it'll be more of a software company. Kind of similar to how Apple was always considered a hardware company, and now that their software revenues start to make up more of their total revenues, it's becoming like a nice blend, and they're hoping, investors hope it'll become more of a software company because of the higher margin, higher cash flow. That is still yet to be seen on Tesla, but that is the growth lever there. And that's what Cathie's banking on big time. So if Elon's successful there, Tesla still has a lot of room for upside. As we move down this list, TDOC is an interesting name. I have my concerns about Amazon making some serious moves in this space. But the valuation, if we're going to go right here, guys, I had Tesla already here, just talking about some financials. I think when we look at TDOC, right, I think at 4.5 times sales on consistent 20% revenue growth is solid for this name. Had a great day today, caught a good bid off its bottom in the upper 50s, I believe it was. They're going to start driving an EBITDA here. So at 33 times this year's EBITDA, it's hard to argue against TDOC. The Livongo merger and everything has made this wishy-washy for a lot of investors, and a lot of people are upset that it happened. But at an $11 billion market cap, I actually see some decent upside in TDOC here. So I'm not against this name. This is one I'm okay with that Cathie owns personally. Roku has been taken to the woodshed. See, what we're going to be talking about a lot here, and you're going to see this consistently, is, all right, now that this ETF has pulled back 60% from highs, the valuations got to start to make sense eventually, right? So when it comes to Tesla, okay, that's one's been the least off its highs. But we look at TDOC, okay, that used to be a $300 stock. Now it's in the 60s. Roku used to be, let's see here. Roku at its peak was, overview. Roku was pushing $500 a share, and now it's down to the low 100s. So at 4 times sales here, okay, and 30% revenue growth this year, 30% revenue growth expected next year, 22% after that. I think Roku is a decent buy here. For a innovation ETF, this is where I kind of scratch my head with Cathie. This is where I kind of get a little, flabbergasted a little bit. It's like, are you really getting much innovation out of Roku here? I mean, yes, it's a good company, but when the flagship fund has the word innovation in it, I'm not sure if this fits the bill. With that being said, it is a little expensive on an EBITDA basis. They're not going to drive in any considerable earnings per share for many years to come. So I am not too excited about Roku. I don't think it's a short here. I think it's an all right buy, less so than the 2 names we already mentioned for sure. I don't think this is the strongest name in the pile. We look at Zoom. Zoom is all right, guys. I personally don't like this name. I think it's very one-dimensional. I've been pretty bearish on DocuSign for the last year and a half or two, and that's panned out as it has with Zoom. I've also been bearish on this name, and it's panned out. I don't know how much is left to really squeeze on this name because they do drive in profits. But again, innovation. Where is the innovation here? This is a name that can be replicated. I don't see much of a moat. If there was a moat, then right, Cisco would have been able to keep market share. But a very one-dimensional company. And when I'm looking for investments, this would not fall into that category because I want to see more of an offering. So Zoom, now it's kind of like each name so far that we've gone through, I've liked less. So Zoom is not there. Block, formerly known as Square, I'm actually a fan of this company. I think it's been oversold. Them and PayPal and many other fintech companies, I think have been pushed way too far into oversold territory. There's a lot of growth drivers still there. So Zoom is going to really fall into very, very moderate growth where the levers for Block are massive. So I am a fan of Block here. Coinbase. Okay, so this is interesting, and I've modeled Coinbase. I'm not going to share that model because it would take way too long to go through. But Coinbase is a trusted name. I am still long-term bullish on crypto. As many of you guys know, I've been in Ether for a very long time. I've trimmed my holdings. So I'm in at 300. I trimmed my holdings at 4,000. And I am looking to perhaps step back in again to rebuild that position. Long-term, my bullishness is still there. Near-term, a little less so. But Coinbase is a decent name. This is a name that Jim Chanos is now shorting because he thinks fee compression is going to start to settle in and batter the names as it did with Schwab and E-Trade and Robinhood. Not batter the names in the sense of those company valuations went down, but batter Coinbase because of the fee compression, which would crush their revenue and profits. I still think Coinbase is a decent buyer. I'm not going to go through the model, but my model says fair value is around $200 a share, so it's around there now. So I think it's decent. In my bull case model, there's about $30 to $40 more of upside, but I think in this market where there's so many dips, I would not say it's the best buy out there in the market right now, but I can see why Cathie has it in her innovation fund. Unity is a nice name, a little on the expensive side, so if you do play video games, there's a good chance it was developed alongside Unity somewhere along that road. So I do think Unity is a decent buy here as well. This makes sense in the innovative space. There's a lot they can do in the metaverse. Video games are always going to grow, and that's something that I like there. Exact Sciences, I see why it's in the innovation fund. I really don't know enough to comment on this space. When it comes to genomics and biotech, I don't want to speak where I am not well versed in. So I'm going to let this name slide here and not add too much there. Twilio and UiPath. These are two tech companies that I am a big fan of. My models say they are now undervalued. I don't have a position in either of them, but I have been contemplating it. So I do like Twilio and UiPath. That makes sense. So Twilio is a communications platform as a service, and UiPath is a tech company, a software company that's trying to get big into automation. So I like those two companies a lot. Spotify, I'm just going to stop here at Spotify. I am not a fan of Spotify at all. I don't like the business model. I think the margins are too thin. I think growth has peaked. I am not a fan of Spotify here. I have modeled it. I do think it's overvalued. And I just don't see the upside. I think there's a lot of competition in this space. I know there's rumors that they're going to try and rival Netflix by potentially going into video. I'll believe it when I see it, but I just not a big fan of the name. As we go through maybe something else on this list here, Shopify I'm a fan of, DraftKings I'm a fan of, Robinhood I am not a fan of. Roblox is a decent company. My models say it's undervalued here. A lot of these genomics companies I completely understand. Stratasys, I don't understand their holding. It's small at 1% weight. I personally do not think it's the best 3D company on the market, so I don't know why she has a position in it. C is a phenomenal company. I don't know why her weight's too small here. Materialize, 2U, Berkeley Lights has been getting dogged. Too Simple is weird. I know what she's trying to go for here. This head name has gotten battered. They are working on L5 autonomy for semis, but it doesn't really make too much sense to me why she would own Too Simple, because she has Tesla, and if she thinks Tesla's going autonomous, then she would also assume that the semi is as well. So there's a little overlap here, and Too Simple is not expected to do anything revenue-wise materially until, maybe 4 years out. So I don't understand why she would make up 1% of her portfolio here when there's a lot of other innovation names that I think she could tap into, or she can average down, sell this position, and average down in some other names which she's down heavy on. But to see like PacBio and Veracyte, good companies, even Roblox, over something like a C doesn't make sense to me. I would let go of Berkeley Lights. There are other better competitors in the space. But yeah, I would say that as we look here at her ETF, I think Cathie does need to make some edits here. I don't think this portfolio, as it stands today, is going to get her back to where she needs to be at all-time highs. Before we get into that a little more, What I do want to discuss, and as I mentioned to you, that Sharpe ratio. The Sharpe ratio, guys, it's one method. It's not the end-all, be-all. It's something we talked a lot about in business school. It's the return minus the risk-free rate over the standard deviation. Rule of thumb is that if it's over 1, right, the number that you get when you do the math, it would be considered pretty good. Over 1, over 2 is fantastic, over 3 is unheard of. And I have Morningstar here, which is showing her Sharpe ratio at 0.84, and I also have Fidelity here showing it at 0.84. Now, these are both on 5-year horizons, so they don't give me anything for the entire time, which I wish they did because I would like to see how it goes there. So, slightly under 1 here. Again, this takes into account the standard deviation, so if Cathie sees a decent bounce in her ETF, this could maybe get back to that 1 range that she was probably well over a year ago. So this goes in line with what I'm saying. It's decent. The portfolio is doing decent. I think CNBC gives this portfolio a lot of chatter, a lot of hate. I think a good amount of it's not really justifiable. It just looks to me like people have a bone to pick with her. I don't know what exactly it is, but as I look at her holdings, I don't think like ROKU is getting back to all-time highs. I don't think Teladoc's getting back to all-time highs. There's a lot of names here that are going to struggle to get back to all-time highs. DraftKings can, but they got to work on their cash flow a little more. I would like to see her get a little more concentrated. Like, I would let go personally of all these names that are under 1% or add to them and make it maybe a larger portion of her portfolio. So I would give this, if I had to grade it, at this point in time, C+, as it stands today, going forward, C+, B-. That's where I would put Cathie's portfolio as it stands today. So, as I mentioned, now we're going to go through the Shopify model. Now, this is a nice sneak peek for you guys. As part of the subscription, I provide a ton of these on many of my holdings and other names we're always talking about. So, guys, I highly encourage you, if you're interested in models, research reports, yearly and quarterly outlooks, newsletters, you name it, join the subscription. Over 200 people, amazing in-depth discussions, and we're focused on long-term investing. As you can already tell, I'm all about the long-term investing, the fundamentals. So let's get into it here. I'm going to show you exactly why a name like Shopify, and I'm using Shopify specifically because it's in ARKK, and I want to show you the effect the macro environment has had on a growth name like this. Many of Cathie's names are growth names, okay? Hence innovative. And a lot of them don't have cash flows. Some of them do, but they're not heavy duty cash flow. A lot of them are out more into the future, so they get discounted harder. But let's backtrack for 1 second. What's been going on in the macro? Well, if you're in the markets, you should at least know this, but if you don't, let me brief you up real quick. We dropped interest rates to keep the economy alive. We dropped them to 0% in the wake of the pandemic to avoid a prolonged recession, if not a depression, okay, to keep growth alive, to keep business activity going. And now we have to bring those rates back up to normalize the economy and to also combat 7% inflation, which has been taking a toll on the consumer. And when you increase rates, that increases the cost of your equity and the cost of your debt. And when you do that, it affects your future cash flow. So in a discounted cash flow model, all right, you have to discount all the future cash flows, and the ones that are further out get discounted at a heavier rate. So I'm going to show you, using the risk-free rate being the 10-year, how that's had such an effect. Now, this is just one reason. It's not the end-all, be-all. Again, there's so many variables in investing, but I'm going through some of them for you guys. So as you guys can see here, all right, this is my discount rate. The discount rate is the risk-free return, which is usually the 10-year. Some people use the 30-year. I'm going to use a 10-year for this case. All right. It's added to, in parentheses here, I have the market risk premium times the beta, the systematic risk of the stock, okay? But that's a whole other thing. We can do a whole other video on that. What I just want to show you is here. If we go with a 1.1%, all right? If we go with a 1.1%, excuse me, let me edit this here. 1.1% risk-free rate. This is what it was when Cathie's portfolio, her ETF, peaked. The 10-year was at 1.1%, all right? It made the weighted average cost of capital for Shopify 7.98%. You see here, I have all my financials for the company. I'm projecting them out, going off current free cash flow and everything. Okay, I have free cash flow peaking at 25%, and I have all my other metrics here. I have a buffer for my discount rate to get a nice little range of where I think the price target can fall. I have the same thing, the perpetual growth rate, but again, we can save that for another video. But what you see here is and disregard this is when I did the model. The base case that I got for Shopify was $966 during the peak of ARKK. I said, you know what, guys, with current rates where they are today, as the risk-free rate using the 10-year, I think a fair value for Shopify is $966. I think peak bull case, $1266. Generally, what I tell my members, if a name goes below my bear case, it falls into pretty heavy buy territory. Okay? Again, you guys can see all these other models that I have. I'm just giving you a little sneak peek into Shopify here. But now the 10-year, guys, now the 10-year is pushing 2.2%. All right? Now let's see how that affects the model. Okay, now the discount rate goes to 9.1%. What were we at? 966? 694. 694 is where I get fair value. Now let's go right here for a minute. Let's also go here. Let's go Shopify. 727 is where shares currently stand today. So let's edit that. Now I would say in my model that Shopify is properly valued. If it's within 5% to 10% of my base case, I would say it's properly valued. So I think now Shopify is properly valued. When it hit 525 a couple weeks ago, I told the members, I said, guys, my models say it is now in buy territory. Why? Because it fell below my 588 bear case downside price target. And now it is back above my base case. So I see upwards momentum here, potentially to 844. Above 844, I think shares are overvalued. So if I just go back to this here. So the 10 years at 2.4 right now, actually, guys. The 10 years at 2.4. It gained 6 basis points today. If I edit that here and use 2.4, you can see it's now dropped to another 4%. It's now 659. So I think shares are properly valued here for Shopify. And I would not be a buyer of the name today. But the point I'm making here is that you could see when the 10-year rises that hard, it's going to affect the stock price dramatically. So at its peak, Shopify was hitting $1,762 a share. This, in my opinion, was way overvalued. I don't think the stock ever deserved to be here. When I changed and edited my models, I could never really arrive at a $1,700 price target. It just wasn't happening. So now off this bounce here, because Shopify did hit around 520, 510 at the low, this bounce here, $200 bounce, I think now it's properly valued. And I don't think that's coincidence. It happens with many of my models, where the stock falls below my bear case and quickly gets eaten up because it's now fundamentally undervalued, and I think the market starts to pick up on it big time. So let's answer the question, guys. Is Cathie Wood's ARKK ETF dead? Contrary to popular belief, I'm actually going to say it's not. I do think it's seen all-time highs, but I don't think it's dead. And the only way it can ever see all-time highs again, in my opinion, is if she does a few things. One, Cathie, you need to stop averaging down on names like Zoom and Roku. Those, for the most part, were stay-at-home monsters. So unless you're expecting another pandemic with lockdowns, stop doing that. Okay, number two, those names at the bottom that you own less than 1% of, scrap them. I'm familiar with a few of them. They're not going to double, at least not in your 5-year time horizon that you have. So let those go and average down on names like C and Twilio. That would be so much smarter. And if you're not going to do that, how about you focus on some smaller cap names? That would help you big time and maybe drive some more alpha, because a lot of these small caps have gotten butchered too, and they can give you those 5 to 10x returns to help give your portfolio that extra little 5-6% that goes a long way in generating alpha. So unless she makes these edits and these adjustments, it's not dead, but it'll be a very long time before she sees all-time highs. So guys, I hope you enjoyed this video. Throw the Instagram, the Twitter, the podcast at CubeCast on Spotify and Apple. I stream every Wednesday night, 8 p.m. Eastern time on Twitch and YouTube. Check that out. But on top of that, guys, I would love for you to be a subscriber, see everything that I own, all these models. If you like that Shopify model, I have hundreds more for you, and you could see what I own, get the research reports, the newsletters, the yearly outlooks, all that stuff. So guys, thank you so much. I'm so happy to be back here on video this time, here on YouTube. So I'm looking forward to giving you guys more content. Leave me a thumbs up, throw the page a follow, tell your friends, and let's do something big here, guys. Talk to you soon.